How do you know if your trading signal is doing a good job? You could embed that signal into a strategy. You could embed that strategy into a portfolio. But then you don't know if it's because of the signal or the entry exit conditions, the weightings, the constraints. We want to boil it all down to the signal, by which I mean, don't forget, just like we did in class, +1 for long, 0 for neutral, and -1 for short. Just from that vector, we should be able to determine whether or not the signal is doing a good job. So on the share screen right now, I've got this Quarto document. It's a demo of a function. That function's going to take in some of your information. It'll tell you on cross-section of assets, +1, 0, -1, et cetera, et cetera. It also is going to require you to input the returns in the test period. And then it will produce a whole slew of different indicators. So I want to mix together three things here: a demo of this function, Excel, as well as some lecture notes. So as we've done in class before, right? Start it up, you wipe everything clean. And if you're working with me, we have the package loads, R function, which is going to load in all the various packages that we need, as well as sourcing other supplemental. We're all good to go. Okay, so what I want to do is play with some toy data. I'm going to set a seed. Don't forget, the seed is a way to recreate your work. Whenever we're randomizing, we want to make sure that we can identify the one that we're reusing. I'm going to set that seed. Now I want to create 300 assets. If it was the S&P 500, I would pick 500. And I'm creating a bunch of tickers of the form A001, A002. N is the number, tickers is the name I'm giving to the vector A, and then I'm adding on 1 through N. So you can see right up here, if you could follow my cursor, A001, A002. Okay. We want to create oh, look at that. I should be fired, misspelled, vector of the single strength. And I'll just randomize it. I'll put it R norm, which means that it's just going to be a bunch of random noise that's going to be around 0, which is going to give me some negative, some positive, some big, some small, because it's normal. So now what I want to do is create a position vector around some threshold. And again, I'm just arbitrarily picking this. What this is going to do is say, first we defined tau. Tau is going to be like a thresholding effect. And I want to take the value of 1 long, effectively 1, if this signal from the signal matrix vec is above 0.05. And I want to go -1 short if that signal is less than minus 0.05. Everything in between is just going to be 0. So if else, it's kind of like in Excel where you do if commands. So if else, if that signal vector is greater than tau, call it 1. If it's not, then let's see what we do next. Okay, well, then we're going to put on an additional if statement. If that signal vector is less than minus tau, call it -1. If not, then what do we do? Everything else is 0. Okay. So then what I want to do is take that signal vector and I want to apply it to some returns in the test periods. I'll just simulate some returns. I'll have normal, again, R norm, of 300, that's the N, 0.05 variance, just floating around, standard deviation. Return simple, so I'm doing zero point zero 0.01 times whatever is the size of the signal that we defined before, plus some random noise. Okay, so the returns on the asset are zero point zero 0.01 times whatever is the size of the signal. Now, why 0.01? I just picked it randomly. This is all simulated. So I'm kind of pulling in the size of that signal. I could have amplified it as well, plus some random noise. I chose this because it's very similar to the types of return processes that you would see and the signal vectors that you might see. Okay, so now we need to format a couple of things, only because I want to embed them inside of the function, and the function requires a certain format. So we'll create a data frame called signal position, which sucks in the tickers and the 1, 0, -1, 1. And the test returns, which sucks in the tickers, plus that random noise of the future returns. We'll have some metadata, and in fact, the benchmark name isn't even really needed. I can get rid of that. And then we'll start embedding that into the signal. Now, if you don't remember, what you can do is hit that little kind of upside down play button to run all the chunks above. We want to set a return threshold for classification. This is different than this tau. The return classification is going to be whether or not the returns in our confusion matrix, we talked about it in the notes, but I'll go through it again, is above or below a particular level. They could be the same. They don't have to be the same. I'll show you where that comes into place. So I'm going to set that threshold to determine if I'm successful or not. And then I'm going to call out to our signal evaluation metrics. Now, function. Now I have something in my workspace called signal eval. There was a ton of stuff that just popped up, right? How do you find it? Okay, so you could go signal eval and you could hit the dollar sign and see all the bits and pieces that are there. What I do in this demo for you is I call up each individual chunk and then I interpret each of those pieces, including the viz that comes up. And what I want to do is actually not do it inside of here. I want to do it in Excel to interpret each of the pieces. The reason why I want to do that is not because Excel is better. It's because it probably is the tool with which you're familiar. So if you're just getting used to R or Python or something like that now, let's go back to the lowest common denominator. One thing that's not easy to do in an Excel tool are these nice viz. So I'll show you those, then we'll switch over. So a viz like this, it's showing the return by signal. So for logs, those where I had a 1 in the signal position matrix, what's the distribution of the test returns among those 300 assets? So for all those 300 whittled down to those that I went long on, this is the distribution. And it's got this violin plot, so that the thicker that violin, the more of them that there are. And you would typically see it in the middle, it's bigger. And the central tendency, the median part of me is at that line right there. For neutrals, for short, what I would love to see is that this distribution is so that the longs are much higher than the shorts. And I would love to see them compact so that I know, right, the distribution, the variability is uncertainty. So I would love to see them compact really high for the longs and compact really low and negative for the shorts. They're both around zero, maybe a little bit higher for the longs. We have to test that. And we can stratify for different types of thresholds and buckets as well. For those where the return in the test period is greater than the threshold, the return is less than the threshold. And then I can stratify again by finer granularity. So how are we going to test this? Let me pull over this PDF. This is the one that we've been playing with. I want to go to signals. We've defined the signals already. Now I want to talk about evaluating those signals. I'll focus on single holdout periods. Single, signal, single, signal. Try to say that a few times. The multiple holdout periods is very similar. It's just rolling it dynamically. So if you had to figure out whether or not this worked, if you had to go back to here and there and see whether or not longs actually are greater than shorts, you could try to like put a ruler and like, yeah, the line seems higher for long than short, but we need to test that. You go into your toolbox, how would you test that the average return of the longs is higher than the average returns of the shorts? You know how to do that already. After we construct the signal, what we would do is we would do a difference in means test. And think about the way that I said it, right? I said, oh, that the return on the longs is higher than the return on the shorts. Okay, so we want to structure a hypothesis test. If you remember the hypothesis test, you're putting the evidence against you, and then you have the alternative as what you're rejecting. So what we're going to do is structure a hypothesis test, a difference in means like this. Um, you may not be comfortable with all of the math. We have to try to structure some of it rigorously. The E is expectation. The R's are returns. The superscripts are test period or train period. The S is the signal. So the first line null hypothesis is saying your best guess. You could have a sample proxy of that with an average. So you could think of it, saying it as the average return in the test period for those in which I went long, signal training period 1, is less than or equal to the average testing period return for those where I went short. This would be testing the difference in long versus short. We could also do long versus not long, short versus not short, neutral versus not neutral. We could do all of those. Now, the alternative is going to be the opposite of this. For it to be a real hypothesis test, we need to encompass all of the possibilities. Less than or equal to and greater than encompasses everything. And don't forget, we want it to be greater than, right? So it's like I want to reject this thing. So we put the burden of proof on the null hypothesis, and then we're going to reject it only if we have that small probability. We can construct a test statistic. Remember, the t-tests are transformations of those averages. We're going to take the difference between the two, and then we scale it. This is a lot of fancy math, but basically what it's saying is take the long average return, the short average return, subtract them, and then standardize it. That's what the denominator is doing. Now we have two samples. They're not quite paired, so we have a two sample t-test. It's one tail, because it's less than versus greater than. And we're going to reject that if the no, then the evidence is in favor of the signal's power. So if I reject, remember reject is a small p-value, then I'm going with that alternative, which means that the training signal of +1 was greater than for -1, that it worked. So let's see that in practice. For that, I'm going to call over another document. So what I did was, hopefully you can see Excel right now. I went into R. I downloaded the tickers, the test returns, and the signal positions across all of them. And what I wanted to do was recreate the counts and tests and p-values that we saw from the output. And we got some, let's see here, average returns of long versus short, their t-stat, p-value. Okay, so that's the bottom line. We could do all the others, but in Excel, I want to focus on that bottom line for now. So the average difference between the two should be a very small 0.008. Is that statistically significant? That depends on the variability of these two. I get a t-stat of 1.48, not quite like that two magic number. The one-sided p-value is 0.06. Not bad. I would love it if it was smaller, but it is a semblance of support in favor of the long versus the short. And don't forget, this is all randomized data, right? I made it up. So there was no guarantee that it would come out this way. So what I did was create, and I'll give all this to you because I'm a nice guy. I created a computations tab that goes through the calculations to construct that, go over here, focus over here, all right? The average return signal longs. That's what the average ifs command. I'm not going to go through a whole Excel video here. If you want some more info on that, let me know. But I constructed the average with a conditional statement only for those where that column D is equal to 1, where the signal position is suggesting long. I did that for neutral. I did that for short. And then I took the difference between the long and short average returns. I wanted to also compute the accompanying p-value and test statistics. So the way you do the p-value in Excel is with a t-test. That's the signal 1 and signal -1. The exclamation in Excel, if you don't remember, is signaling what is the actual sheet along the bottom. So I created two sheets here. What I did was I copied everything over, and then I went to data and filter, and I went ahead and I filtered out only the ones where signal position is 1. And then on this sheet, only where signal position is -1. So I'm going to use that inside of my t-test. You feed in the vector of the +1s, feed in the vector of the -1s. The order is important because that's going to give you the direction of the one-tail test. If you click on this over here, you can see with the bits and pieces, array 1, array 2, the tails, it's 1, so it's a one tail. And then the type of t-test to perform. And the third one is a two-sample unequal variance for heteroscedasticity. That's a p-value of 0.069. To get to the t-stat that's accompanying it, we use t-inverse. One minus whatever is that p-value. And then we compute the degrees of freedom, where I'm counting up all the longs and shorts and subtracting off the 2 degrees of freedom that I lose. So it's 0.069, 0.069, 1.48, 1.48, 0.0085, 0.0085. Excel is pretty powerful, right? Excel can do a lot of stuff. I'm going to not do these right now. So again, what this means is the chart that we saw over here, where'd you go? Pretty chart. That is statistically different than that, not by much, but it's there. Okay, so that's one. The signal seems to be working a little bit. We can get to a whole bunch of summary stats, means, variances for all different thresholds and all different sorts of stratifications. Next up is this IC table. So what was the IC? Go back to our notes. Let's find the IC. Information coefficient. It's a correlation. It's a correlation between two vectors. If you remember, correlation is always the way two things are moving. We usually think about them as continuous variables, the return on a stock and the return on the S&P. Um, we don't really need continuous. We have a signal that's minus 1, 0, plus 1. So it's a little dichotomous there. But we can still compute the covariance, the relative variances, standard deviations, and construct a correlation. Just like every other correlation, if the number is high, it's telling you that these two things move together. So in our case, if the correlation's high, it's saying that the signal that I get 1, 0, 1, 1, minus 1 now, based on the training period, is related to the returns that I would see in the test period. I want my signal to have a high information coefficient. And I can do that across all of the assets, or I could take a subset. I can take a subset for only those in which I acted, I made a trade, minus 1 or plus 1, short or long, respectively. So the way that you would do that is using some type of binary classification. It's like a binomial distribution, effectively, where P is the proportion of longs and the acted subset. It's equivalent. That's really said like it's almost equivalent to the Pearson correlation between the two. If you have enough data, it should be equivalent. So this information coefficient is only for when you took action. Long or short, you took action. And again, we still want that to be big in absolute terms. Um, how big is big? How big is big? We need a test. And one of the ways we can construct a test is with a parametric form for correlation about whether or not that correlation coefficient from IC or the IC acted is equal to 0, or if it's not equal to 0. If it's a positive number, they tend to be moving together. If it's a negative number, they're moving in opposite direction. And either way, it's giving you some info. So you construct a test statistic and the associated p-value. That's the form of the test statistic down here. If we want our signal to work, I'm hoping that I reject, right? Because then it's saying that they move together in some way. What you could do is get fancy. You could do some bootstrapping, or you could do some permutation tests. The bootstrapping is suggesting, look, if I'm not comfortable with the amount of observations I have, T-stats are like built from normal distributions, but normal distributions need a particular type of form to them where I need enough observations. So maybe I could resample and form some confidence intervals effectively from the resampling. Or for permutation tests, it's not new, but still novel, is what I could do is I could reshuffle the labels of who's long or short, do that thousands and thousands of times, and then create a distribution for that null, pull out the empirical p-value. We're not really going to do that, but I just wanted to mention there's other ways in which we could make these tests. So let's construct the information coefficient in that lowest common denominator that you might be familiar with. Excel. So over here, I construct the information coefficient for all the assets. How do I do that? It's correl. It's a correlation between column C and column D. And let me see if I can scooch over enough. Between the test return, testing period return, and signal underscore position, 1 or 0 or -1. It's 0.085, not very big. I can construct the test statistic of the form that I showed you on the slides, and then I can construct the associated p-value. It's a two-tailed t-distribution, M5, so that's all of the assets, -2, 2 degrees of freedom. 0.14 should match in the ballpark of what we got here, 0.14, 0.087, 1.47667. I said 67. Aye, aye, aye. What does that tell you? The correlation p-value is pretty high, 0.14, which means I'm going to fail to reject, quote unquote, accept that the correlation between the two is 0. So I'm not getting a lot of information from the signal according to the information coefficient in terms of that magnitude. They're really not moving in similar directions. I could take a subset of this and look at what's acted on, meaning only on those subset of assets where I pulled the trigger, long or short. And I did the same formulas effectively. The construction for the information coefficient is slightly different. It's not just a correlation. The correlation actually would be a close proxy to it. I'm following the formula from the slide where I'm using this notion of a binomial. So I'm getting that empirical probability, and then I'm constructing the t-stat and p-values before, but it's still 0.139. Again, there's not a lot of information about the way the signal is set and future returns. It would be lovely if what we saw here jived with what we saw there, but it's not always going to be the case. All right, so what else do we have in our bag of tricks here? We got a hit table. What's a hit table? So the hit rate is another measure of success, 0.527. Let's go to the slides. I'm going to skip over confusion matrix for now. Find me some good old hit rate. Where are you at? Where are you at? Where are you at? There we go. It's a measure of connection between the signal today and the return tomorrow, which sounds an awful lot like the information coefficient, but this isn't about whether or not the signal today is pushing the returns higher or lower. The greater the returns, the greater the correlation coefficient. So the information coefficient has a degree of magnitude to it. Hit rate is just about positive, positive, negative, negative, same direction. The way that you would compute that is effectively with some dummy variables. The bolded ones are dummy variables. Sometimes you'll see them as I, sometimes you'll see them as D. It's just a dummy variable. The first one, the hit rate, is just saying take the training signal, take the return testing period, multiply them, and tell me whether or not they're of the same sign. If they're of the same sign, then when you multiply, they'll be positive, right? Long and long, long. Short and short, positive. If they're in different directions, then you'll have a negative. So just taking the average of a column of ones. And then likewise, the hit rate for the actin is going to take of the subset where it's not neutral, hence the S train not equal to 0, at a fraction of those not equal to 0. And then we could test them, right? So we could test that hit rate with a binomial approximation. If you remember binomial, what you could do is you could set up whether or not it's equivalent to random. The null hypothesis is that the probability is equal to 0.5 or not equal to 0.5. If the null hypothesis is quote unquote accepted, failed to reject, then we're saying it's just random. It could have been a coin flip. We want it different than random. That's our hope. So I set up a z-stat based off of my estimated probability and the random guess, and I can construct the exact binomial if I wanted to, but what I want to try to do is use a z-stat. If you remember, 1.96 in absolute terms, that's when it's extreme, that's when I would reject. So let's see if we can create that. So let's construct the hit rate In Excel, it's the average of column G. What is column G? Okay, so in column G, let's go over here. I did a conditional statement on column F. What's column F? Column F, I multiplied the test return and the signal, just like in the slides, right? So go ahead and multiply those two. If they're of the same sign, then column F should be positive, give me a 1. If not, give me a 0. So the hit rate is just taking the average across those ones or zero signs going the same direction. Construct a Z-stat, analogous to the way that I had it on the slide, the zero point 0.5 representing that coin flip probability, and then the associated p-value. It's two-tailed, so what I do is I take 2 times 1 minus the norm of the norm.s.dist in Excel. That's the way in which you can construct that distribution of the normal. Absolute value of L21, which is that z-stat, right? Because it could be negative or positive. I don't really care about that. I'm just trying to get the absolute value off of it. That'll give me the p-value. 0.35. Let's see if that matches R. 0.35. The z-stat of 0.92 and the hit rate of 0.527. Looks like it works. Okay, so is that a good thing or a bad thing? Let's go back to over here. I am with a large p-value, which means that I fail to reject or I accept the null. So it's going in basically a random direction. This isn't really giving me much of a great signal. And to act it on as well, I can just do subsets, and you can see it's basically the same thing. It's a little bit stronger in terms of p-value, but it's still not telling me a lot. So a little bit of the mean difference between the two, not much from the magnitude of the information coefficient, not much from the direction from the hit rate. What else we got? Well, what we also have is some information on a confusion matrix. Long versus not long, short versus not short, neutral versus not neutral. 3 states of nature. TP, FP, FN, TN, accuracy, what are all these things? This is what's called a confusion matrix. The idea is going to be that I want to see how often I'm right out of a fraction of all the observations, how often I'm wrong out of a fraction of all the observations, and what types of mistakes I'm making. So I need to set a framework for that. That framework is called a confusion matrix. I need to have it so that I'm looking at all the possibilities, kind of like in a null hypothesis. So I'm going to do long versus everything else. And analogously, we could do short or neutral versus everything else. Let's go to the tape. Right. So I'm going to set a threshold of 0.0025. Where does that come into? Let's check out the slides. Go back up to the confusion matrix. Bum, 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 bum. And let's do the one where it is long versus not long, i.e. short or neutral, right? So it's long versus either short or neutral. What we're going to do is look at what was predicted up at the top. I predicted a good return, so I went long, S train 1. Or I predicted it wasn't going to be a good return, so I either went short or neutral. And then I'm going to look at what actually happened over in the row labels. The test period return was positive or negative, or it could be thresholded. So return of the test period greater than 0.0025. I just picked that randomly. Okay, so the slide has it for 0, but it could be for any threshold. And then what I want to do is count. I want to count how many times I went long when it actually worked, true, positive. I want to count how many times over here I went either short or neutral, and it was negative, or true, negative. Okay, so those are good. What about bad? I want to count false positive. How many times I said, let's go long, but it turned out to be bad, false positive. I want to count false negative. How many times I avoided it, but it was actually good, right? So false positive, false negative are 2 different types of mistakes. One where I took an action I shouldn't have, false positive. One where I did not take action when I should have, false negative. And in your context, you got to figure out which one is more harmful, keeping up with the rest of the market or putting a position on when you shouldn't have, and you might lose money. So we can just count those and you can get a sense, or you could take some um, metrics that summarize them. The first one's going to be the accuracy. I want you to sink in. What is that saying? So that's true positive plus true negative. All the good stuff as a function of or divided by true positive, true negative, false positive, false negative. So all the good stuff on the diagonals scale by everything. So what fraction of all the correct moves that I make? What fraction of all the possibilities that I have, in our case of all the 300 assets, that I make the right move? Then there's precision, recall, specificity, type 1, type 2. Now, to interpret the rest of them, I have some presents for you. Which we can do is the fraction of all trades where the signal correctly anticipated the sign. How often I got the sign right. See if you can do the precision. It's using in the numerator TP, that true positive, as a function of not everything, as a function of only TPFP. So what's going on here is when I go long, how often am I right? Recall. Again, it's true positive as a function of true positive plus false negative. So the denominator is different. Now it's going across that top row. What's my winner capture rate? Out of all the times when I should have gone long, what fraction of them did I go long? The true negative. Okay, so that's again something that I'm doing right by avoiding. Did I avoid going long the losers? Type 1 error, type 2 error should sound familiar. That's like from hypothesis testing. False positive is again that situation where I bet on long, but I lost money. So how often did I mistakenly go long? Out of all the times when I shouldn't have gone long, right? Because I'm looking at that bottom row of the false positive and true negatives. Out of all the times when I had negative test period returns, what's the fraction that I incorrectly labeled them as long? And the type 2 is a close cousin to that, missed winners fraction. The false negatives are the ones where I didn't take it, but I should have, as a function of all of the times when I should have taken it. Now you could recreate that for shorts, and I do that for you here as well, and I interpret it, so I'm not going to go through all those. I do want to show you, though, how to construct those inside of Excel, just so you have a frame of reference. All right, so we're going to have our confusion matrix, just like we had on the slides, except rather than only zero, as I mentioned, we could have it relative to a threshold. So let's count. So what do I need to do here? I need to count the number of times that I said long and the returns were greater than the threshold. So count column C. Let me scooch over slightly, which are all the future returns. The second piece is the condition, greater than K25, the threshold. And where column D, the signals, are equal to 1. That's what the last one means. 77 of those. 77 of those. And then you can do counts for all of the other pieces. Okay, so I got the entire confusion matrix set up. 77, 59, 71, 79. Is that good or bad? Well, we could take a look at the accuracy. I want accuracy to be high. And the accuracy is going to be just a combination of the elements of that confusion matrix. 54. Whoop, I broke it. I should buy it. 54%. So without even testing it, we had other ways to test, but I'm right. I'm accurate 50-ish percent of the time. That doesn't sound great. Precise 56%. Remember, what does type 1 and type 2 error mean? Go back to the slides. Type 1 and type 2 error for the long versus short. Mistakenly going long. Mistakenly going long over 40% of the time. And the type 2 is I'm missing winners 48% of the time. Not so hot. So now looking back on it, I probably should have made my demo looking awesome, but you can see now from our structure in our demo file that you have all the bits and pieces available to you to go through the basic density comparisons, the hit rate, information coefficient, and confusion matrix to answer the question, did your signal work? Before you get to a strategy and before you get to a portfolio. Hope that helps.